You know what's fascinating about silver right now? While everyone's been watching gold hit record after record, silver's been coiling like a spring under pressure, and that spring is about to release in a way that's going to catch a lot of people off guard, especially the short sellers who've been betting against it. Let me show you what's happening beneath the surface because the signals we're seeing right now are the same ones that preceded every major silver squeeze in history. And if you understand what these signals mean, you'll understand why some of the smartest money in the world is positioning for what comes next. Silver just crossed above its 200-day moving average and held it. Now that might sound technical, but here's why it matters. The last 3 times silver broke and held above that level, it rallied an average of 47% in the following 6 months. But here's the thing that makes this time different. The short interest on silver is at levels we haven't seen since early 2020. You remember what happened then, right? Silver went from $12 to $30 in less than a year. But let me back up and explain what's actually happening in the silver market, because this isn't just about chart patterns. This is about a fundamental supply and demand imbalance that's been building for years, and it's finally reaching a breaking point. Silver is unique. It's the only metal that's both a monetary asset and an industrial commodity. And right now, both sides of that equation are screaming higher prices. On the industrial side, we're seeing demand that's absolutely exploding. Solar panels alone are projected to consume over 200 million ounces this year. That's nearly 20% of total global production. Electric vehicles use about twice as much silver as traditional cars. 5G infrastructure, medical devices, water purification, electronics, the list goes on. But here's where it gets interesting. While industrial demand is surging, mine production is actually declining. We're seeing major silver mines in Mexico, Peru, and Bolivia facing operational challenges. Environmental regulations are tightening, energy costs are rising, and here's the kicker. Most silver comes as a byproduct of other mining operations. About 70% of silver production comes from mines that are primarily digging for copper, lead, or zinc. So when those operations slow down, silver supply contracts even if silver prices are rising. Now, let's talk about what's happening on the monetary side, because this is where things get really interesting. Central banks around the world have been accumulating gold at record pace. But silver? Silver's been largely ignored by official institutions. Until now. We're starting to see subtle shifts. Sovereign wealth funds quietly adding silver exposure. Pension funds increasing their precious metals allocations beyond just gold. And the retail investor? They're waking up to something that the smart money figured out a long time ago. The gold-to-silver ratio. Right now, it takes about 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1. But here's what most people don't know. In the ground, silver and gold are found at a ratio of about 8 to 1. That's right. For every ounce of gold in the Earth's crust, there are roughly 8 ounces of silver. So why is the price ratio 85 to 1? That's the question that's going to drive the next major move in silver. Let me tell you a story about what happened in 1979 and 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, started accumulating silver in the early 1970s. They understood something that most investors didn't. They saw inflation coming. They saw the dollar losing purchasing power, and they saw silver as dramatically undervalued. So they started buying, and buying, and buying. At one point, they controlled nearly half of the world's deliverable silver supply. What happened next is legendary. Silver went from $6 an ounce in January 1979 to $50 an ounce by January 1980. That's an 8x move in 12 months. Now, the Hunt brothers' story ended badly. The exchanges changed the rules mid-game, raising margin requirements and restricting new positions. The brothers were forced to liquidate, and silver crashed. But here's what's important. The fundamental supply and demand dynamics that drove that rally, they're back. Only this time, it's not 2 brothers accumulating silver. It's millions of investors around the world who are starting to understand what's coming. Fast forward to 2011, silver hit $49 an ounce. Why? Because investors were fleeing the dollar after the 2008 financial crisis. They were worried about quantitative easing, about money printing, about the stability of the financial system, and they piled into precious metals. Gold went to $1,900. Silver went to $49. But then something interesting happened. The price got crushed. Silver fell all the way back to $14 by 2015. And you know what the narrative was? Silver was in a bear market. It was over. The rally was done. Except it wasn't. Because the fundamentals never changed. The supply and demand imbalance was still there. The monetary concerns were still there. What changed was sentiment and price manipulation. Let me explain what I mean by that, because this is crucial to understanding what's happening right now. The silver market trades in two forms: physical silver, the actual metal you can hold in your hand, and paper silver, which is contracts and derivatives that represent claims on silver but aren't backed by actual metal. The paper market is enormous. For every ounce of physical silver, there are estimated to be over 300 ounces of paper claims. Think about that. If even a small percentage of those paper holders decided they wanted physical delivery, the system would break. And that's exactly what's starting to happen. We're seeing stress in the physical market that hasn't been this severe in decades. The premium on physical silver coins and bars over the spot price has been elevated for months. Dealers are struggling to source inventory. Delivery times are stretching out. The U.S. Mint has had to ration silver eagles multiple times. These are not the signs of a market with abundant supply. Meanwhile, on the COMEX, the futures exchange where silver contracts trade, we're seeing something fascinating. The commercial traders, the big banks and institutions that typically short silver to hedge their positions, they're covering those shorts. They're reducing their net short position at the fastest pace we've seen in years. Why would they do that? Because they see what's coming. They understand that holding a short position in a market with this kind of supply stress is financial suicide. Let me paint you a picture of what a short squeeze looks like, because if you've never experienced one, it's hard to understand the violence of the move. A short seller borrows silver, sells it, and hopes to buy it back cheaper later. That's the bet. But what happens when the price starts rising instead of falling? The short seller starts losing money. And if the price keeps rising, those losses accelerate. Eventually, the short seller is forced to buy back the silver they sold. But when they try to buy, that buying pressure pushes the price even higher, which forces more short sellers to cover, which pushes the price higher still. It's a feedback loop, and it can happen incredibly fast. We saw this in nickel in 2022. The price went from $25,000 a ton to over $100,000 a ton in 2 days. 2 days. The London Metal Exchange had to halt trading and cancel trades because the short squeeze was so severe it threatened to bankrupt major participants. Now, I'm not saying silver is going to quadruple in 2 days, but I am saying that the setup we're seeing right now has all the ingredients for a significant squeeze. Here's what makes this particularly interesting for anyone thinking about their financial future. Silver is affordable. You can buy an ounce of silver for around $30. Compare that to gold at $2,600 an ounce. For the average person trying to protect their wealth, trying to hedge against inflation, trying to own something real in a world of paper assets, silver is accessible in a way that gold isn't. And that accessibility means that when sentiment shifts, when people start to understand what's happening, the buying pressure can be enormous. Now, let me take a quick aside here, because if you're someone sitting on a significant retirement account, $100,000 or more, and you're thinking about how to protect that wealth, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. It's worth checking out if that's relevant to your situation. But let's get back to what's happening in silver right now, because the next few months are going to be critical. The technical setup is compelling. Silver's been consolidating in a range for months, building energy. We're seeing higher lows, which tells us that buyers are stepping in at higher and higher prices. The 50-day moving average just crossed above the 200-day moving average, what technicians call a golden cross. Historically, that's been a bullish signal. But more importantly, we're seeing volume increase on up days and decrease on down days. That's telling us that the momentum is shifting to the buy side. But let's talk about the fundamental drivers, because that's what's going to sustain any move higher. The solar industry is projected to double its silver consumption over the next 5 years. Think about that. Double. Where's that silver going to come from? Mine production is flat at best. Above-ground inventories are declining. The COMEX warehouse stocks are at multi-year lows. The Silver Institute, which tracks supply and demand, is projecting a deficit of over 200 million ounces this year. That's the sixth consecutive year of deficits. Now, you might be thinking, if there's been deficits for 6 years, why hasn't the price exploded already? Great question. And the answer comes back to that paper market I mentioned earlier. As long as the price is determined by paper contracts rather than physical supply and demand, the market can stay disconnected from fundamentals. But that disconnect can only last so long. Eventually, physical reality asserts itself, and when it does, the adjustment is violent. We're seeing signs that adjustment is beginning. The Shanghai Gold Exchange, which deals in physical metal, has been showing premiums over the COMEX price. That means buyers in Asia are willing to pay more for physical silver than the paper price suggests it's worth. That's a red flag for the paper market. It's telling us that the physical market is tighter than the paper market is pricing in. Let's talk about what's happening with the US dollar, because that's a huge driver for precious metals. The dollar index has been under pressure. We're seeing countries around the world reduce their dollar holdings. The BRICS nations, Brazil, Russia, India, China, South Africa, they're actively working to create alternative payment systems that bypass the dollar. Saudi Arabia is now accepting yuan for oil sales. That's huge. The petrodollar system, which has been a cornerstone of dollar dominance for 50 years, is cracking. What does that mean for silver? When confidence in the dollar declines, people look for alternatives. They look for stores of value that can't be printed, that can't be debased, that have intrinsic worth. Gold and silver have been money for 5,000 years. They've survived every empire, every currency, every financial system, and they'll survive this one too. Here's something most people don't realize. The total value of all the silver ever mined that still exists in investable form is only about $40 billion. That's it. For context, that's less than the market cap of many individual tech stocks. It's a rounding error in the global financial system, but it means that if even a small amount of capital flows into silver, the price impact is enormous. If just 1% of global financial assets decided to allocate to silver, we're talking about a price that would make today's levels look quaint. Now let me tell you about what happened in 2020, because it's instructive for what we might see next. In March 2020, when the pandemic hit and markets crashed, silver fell to $12 an ounce. But then something interesting happened. The Reddit community Wall Street Bets started talking about silver. They understood the supply and demand dynamics. They understood the short interest. And they started buying, not just paper silver, but physical silver. Coins, bars, anything they could get their hands on. The result? Silver went from $12 to $30 in less than a year. The U.S. Mint couldn't keep up with demand. Dealers were sold out. Premiums on physical silver exploded to $10 over spot. The paper market was pricing silver at $25, but you couldn't buy physical silver for less than $35. That disconnect, that stress in the physical market, that's what we're starting to see again now. But here's what makes this time potentially more significant. In 2020, it was primarily retail investors driving the demand. This time, we're seeing institutional interest. We're seeing family offices, hedge funds, and sovereign wealth funds adding silver exposure. These are sophisticated players with deep pockets, and when they move size. The silver ETFs, the exchange-traded funds that hold physical silver, they've been seeing inflows. The largest silver ETF, SLV, has added over 50 million ounces in recent months. That's physical silver that has to be purchased and stored. It's coming out of the available supply. And every ounce that goes into an ETF is an ounce that's not available for industrial use or for other investors. Let's talk about what this means for the short sellers, because they're the ones who are really feeling the pressure right now. When you short silver, you're betting that the price will go down, but you have to maintain margin, collateral, to keep that position open. As the price rises, your losses mount, and you need to post more margin. If you can't post that margin, you're forced to cover, to buy back the silver you sold short. And that's when the squeeze really accelerates. We're seeing signs that some short sellers are already in trouble. There have been reports of margin calls, of forced liquidations. The open interest in silver futures, which represents the total number of outstanding contracts, has been declining even as the price rises. That's unusual. Typically, rising prices attract more participants and open interest increases. But when open interest declines with rising prices, it suggests that shorts are covering, that they're exiting their positions. Here's a historical parallel that's worth considering. In 2008, during the financial crisis, silver initially fell from $20 to $9 as everything sold off. But then, as the Fed started printing money, as quantitative easing began, silver rallied from $9 to $49 over the next 3 years. That's a 5x move. Why? Because investors understood that all that money printing was going to debase the currency. They understood that real assets, tangible assets, were going to hold their value better than paper. Fast forward to today. We've seen unprecedented money printing over the last few years. The Fed's balance sheet exploded from $4 trillion to $9 trillion. Government debt is at record levels. Deficits are structural, meaning they're not going away. And inflation, despite what the official numbers say, is eating away at purchasing power. People feel it every time they go to the grocery store, every time they fill up their gas tank, every time they pay their rent or mortgage. This is why precious metals matter. They're not just investments, they're insurance. They're a hedge against the debasement of currency, against the erosion of purchasing power, against the instability of the financial system. And silver, because it's more affordable than gold, because it has industrial demand supporting it, because it's been so beaten down and ignored, offers asymmetric upside. Let me explain what I mean by asymmetric. If silver goes down from here, how much can it really fall? Maybe to $25? That's a 17% downside. But if silver goes up, if we see a move back to the 2011 highs of $49, that's a 63% upside. And if we see a move beyond that, if we see silver at $75 or $100, which some analysts are projecting based on the supply and demand fundamentals, we're talking about 2x to 3x returns. That's asymmetric. The potential upside far exceeds the potential downside. Now, I want to talk about something that doesn't get discussed enough, and that's the geopolitical dimension of what's happening in precious metals. We're living through a period of significant global realignment. The unipolar world order that emerged after the Cold War is fracturing. We're seeing the rise of multipolarity, with China, Russia, and other nations challenging U.S. dominance. And one of the key battlegrounds in this realignment is currency. China has been accumulating gold for years. They're now the world's largest gold producer and one of the largest holders of gold reserves. But they've also been accumulating silver. Why? Because they understand that in a world where the dollar's dominance is declining, where trust in fiat currencies is eroding, precious metals provide a foundation for monetary stability. They provide optionality. They provide leverage. Russia, after being sanctioned and cut off from the SWIFT payment system, has been aggressively de-dollarizing. They're settling trade in rubles, yuan, and other currencies. They're backing their currency with commodities, including gold. They understand that in a world of financial warfare, where your assets can be frozen, where your access to the global financial system can be cut off, physical assets that you control are the ultimate form of sovereignty. This isn't just about investment returns. This is about the architecture of the global financial system. And silver, as both a monetary metal and an industrial commodity, sits at the intersection of these forces. It's money. It's a commodity. It's a strategic resource. And it's in deficit. Let me give you another historical example, because history doesn't repeat, but it often rhymes. In the late 1960s and early 1970s, the U.S. was running large deficits to fund the Vietnam War and the Great Society programs. Other countries, particularly France, started to question whether the dollar was really as good as gold. They started demanding gold in exchange for their dollars. The U.S. gold reserves were draining. And in 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. The Bretton Woods system collapsed. What happened next? Gold went from $35 an ounce to $850 an ounce by 1980. That's a 24x move. Silver went from $150 to $50. That's a 33x move. Now, I'm not predicting a 33x move in silver from here, but I am saying that when monetary systems are under stress, when confidence in fiat currencies is declining, precious metals are where capital flows. And we're seeing signs of that stress today. The repo market, where banks lend to each other overnight, has been showing signs of strain. The Fed has had to intervene multiple times to provide liquidity. The Treasury market, supposedly the most liquid and safe market in the world, has been experiencing unusual volatility. These are cracks in the foundation. They're subtle, they're technical, but they're there. And smart money is paying attention. Here's what I think is going to happen over the next 6 to 12 months. Silver is going to break out of this consolidation range. We're going to see a move above $35, then $40. And once we clear $40, the path to $50 is open. But more importantly, I think we're going to see a fundamental repricing of silver relative to gold. That 85 to 1 ratio I mentioned earlier, I think it's going to compress to 60 to 1, maybe even 50 to 1. If gold is at $2,600 and the ratio goes to 50 to 1, that puts silver at $52. If gold continues higher, which I think it will, and the ratio compresses, we could see silver at $60, $70, even higher. But here's the thing. This isn't going to be a smooth ride. There will be volatility. There will be pullbacks. The powers that be, the big banks, the institutions that have been short silver for years, they're not going to go down without a fight. They'll try to shake out weak hands. They'll try to create fear. But if you understand the fundamentals, if you understand the supply and demand dynamics, if you understand the monetary backdrop, you can hold through that volatility. Let me tell you what the smart money is doing right now. They're accumulating physical silver. Not paper contracts, not ETFs, but actual metal. Coins, bars, stored in secure vaults. They're taking delivery. They're removing supply from the market. Because they understand that in a squeeze, physical metal is what matters. Paper promises are just that, promises. And in a crisis, promises get broken. We're also seeing smart money buying silver mining stocks. These are leveraged plays on the silver price. If silver goes up 50%, a well-run silver miner might go up 150% or 200%. Why? Because their costs are relatively fixed, so higher silver prices flow straight to the bottom line. But you have to be selective. Not all miners are created equal. You want companies with low costs, strong balance sheets, and growth potential. Here's something else that's interesting. We're seeing innovation in the silver space, new technologies for silver extraction, new applications for silver in medicine, in electronics, in renewable energy. Silver has antibacterial properties, which makes it valuable in medical devices and water purification. It's the best conductor of electricity, which makes it essential in electronics and solar panels. As technology advances, as the world electrifies, silver demand is going to continue to grow. But supply? Supply is constrained. It takes years to bring a new mine online. You have to find the deposit, get permits, build infrastructure, start production. And with environmental regulations tightening, with communities pushing back against mining operations, with energy costs rising, it's getting harder and harder to increase supply. This is a recipe for higher prices. Now, let's talk about what could go wrong because it's important to consider the risks. The biggest risk to the silver bull case is a deflationary collapse. If we see a severe recession, if demand for industrial commodities craters, silver could get hit. But even in that scenario, I'd argue that silver's monetary properties would provide support. We saw this in 2008. Silver initially fell, but then rallied strongly as the Fed responded with massive stimulus. Another risk is government intervention. If silver prices start to rise too quickly, if a squeeze threatens the stability of major financial institutions, governments could step in. They could change margin requirements, restrict trading, even confiscate metal like they did with gold in 1933. It's unlikely, but it's possible. This is why diversification matters. Don't put all your eggs in one basket. But here's what I keep coming back to. The fundamental case for silver is stronger now than it's been in decades. We have supply deficits. We have surging industrial demand. We have a monetary backdrop that favors hard assets. We have geopolitical tensions that are driving countries to accumulate precious metals. And we have a setup where short sellers are trapped, where physical supply is tight, where the paper market is disconnected from physical reality. This is the kind of opportunity that doesn't come around often. And the signal that silver just sent, breaking above key technical levels, holding those levels, showing strength even as other markets wobble, that's the signal that smart money has been waiting for. That's the signal that says the next leg higher is beginning. For the short sellers, the ones who've been betting against silver, who've been suppressing the price, who've been playing games in the paper market. This is their warning. Cover now. Because what's coming is going to be painful. The physical market is going to assert itself. The supply and demand fundamentals are going to matter. And when they do, when the squeeze really gets going, it's going to be too late to exit gracefully. For everyone else, for the people who understand what's happening, who see the writing on the wall, who recognize that we're living through a monetary transition, this is your moment. This is when you position yourself for what comes next, not with everything you have, not recklessly, but thoughtfully, strategically, with a portion of your wealth allocated to real assets that can't be printed, that can't be debased, that have intrinsic value. Silver just sent a signal. The question is, are you listening?